So you've hit a financial milestone in your life. You've stabilized your income. You've been able to manage and pay your expenses. You have some excess cash flow, or maybe you have a lump sum of money, bonus at work, tax return, settlement, inheritance. You're trying to figure out, where do you put that money? Where do you put that money that makes sense for you and that's going to be as productive as possible for you while you're holding on to that money? You've heard of high yield savings accounts. You see marketing on CDs and you hear shoo-shooing about IRAs. You're not sure which one to go with. That's what I'm going to help you solve for in this video. What I want to do is help give you a framework on how to dissect which one of these saving methods is going to make sense for you, what you need to consider, and the best function that's going to help advance you for that money based on the time frame you plan on holding it. That's important. This is JP from Blueprint for Prosperity Network, helping you master relationship banking and maximize your borrowing capacity so you can customize your blueprint for prosperity. So when you're assessing lump sums of money or excess cash flow is finally building up, first off, congratulations for having that in the first place. A large portion of Americans don't have $500 to reach for in case of emergency. So if you're somebody with 4 or 5 figures or maybe more that you either built up in savings or you ran into in a lump sum, then my head goes off to you because you're in a unique situation. You're trying to figure out, where do I put this money that makes sense? I've heard of various different account types, but I don't really understand the timeline that I should be assessing for these things. Which one's going to give me the better return? Which is the easiest for me to set up that's not going to be a headache? And which is going to give me access to my money in what capacity or time frame if I need it or I choose to deploy it. So we're going to break down the 3 major common accounts that you have the flexibility to open for yourself and distribute this money into. So the first is going to be high yield savings accounts. If you look at the Google guys, they're going to tell you a high yield savings account offers variable interest rates and more flexibility for withdrawals. So high yield savings accounts are deposit accounts. They're savings accounts, hence the title, that give you a higher return or a higher yield on your money. So they are essentially savings accounts at the baseline with a higher return. They're a specific variation of savings account that will give you a higher interest rate to park your money into. These accounts are offered at a ton of financial institutions, not all financial institutions, but a ton of them nonetheless. And they're going to be good for typically short-term windows of time. And when I say short-term, we could be thinking anywhere from weeks to a handful of months before that money is going to be deployed into something else. The next option you may have heard about is CDs. If you look CDs up, they're going to tell you it provides a fixed rate over a set period of time. So you can look at a high yield savings account as it's like dating without expectations. You can look at a CD as a form of a committed relationship. Even if it's a short-term relationship, it's some form of commitment. You're agreeing contractually with the bank to lock that money up for a period of time. And in return for that guarantee of that money sitting still, the bank gives you a higher fixed rate on that money. So IRA accounts, individual retirement accounts that offer tax advantage growth. These accounts are much more commonly used for retirement. So that should tell you right out of the gate, they are designed to function for a longer duration of time. They are not short-term or even mid-term options. In many cases, you are limited in your capacity of touching or functioning with this money prior to the age of 59 and a half. So that should tell you right there that this is a longer-term option. CDs, on the other hand, think 3 to 5 year, 3 month to 5 year windows of time. And again, high yield savings accounts, completely liquid, meaning that you can put the money in today and go back and pull that money out tomorrow without any fees. There's no commitments there, but for the duration of time that you have that money there, they're basically assuring that you are getting a certain rate on that money. Now, with high yield savings accounts, something for you to keep in mind. That money, again, is variable. The interest rate is variable. So what that basically means is that interest rate can change at any window of time. As you have liquidity that you can pull that money out at any window of time, the bank or financial institution has the right to change that interest rate at any window of time. There's no commitment. We're meeting each other in the middle and dealing how we choosing to deal for whatever window of time we choose to deal. The bank can change their mind, or the industry or the economy and the interest rates can fluctuate rather, and that interest rate can change literally overnight. You can wake up in the morning and decide you need or want that money and pull that money out overnight. So there's no guarantee on the rate, just like there's no guarantee on you keeping those deposits. But it is a great option if you plan on holding that money for a short duration of time because you're trying to figure out what you plan to do with it longer term. You have, longer term plans. Sometimes you might get insurance money from something. You know that money has to go back out 2, 3, or 4 months, but you want to hold it down somewhere where you can get a little bit of interest for it. in the meantime while you're holding it. Nothing wrong with that. I mean, that's kind of the business model that banks have at the end of the day. So that's high yield savings account options. You want to look at this as something that 1 month, 3 month, maybe 4 or 5 month windows of time, or uncertain periods of time. Maybe it does last longer, but the entire time it's in there, you're completely uncertain of when you may have to withdraw it. That's when a high yield savings account may come into play for you. Still gives you a pretty competitive interest rate, but it is going to be fluid. But that fluidity allows you to also have flexibility in accessing your money. CDs are going to be more attractive if you're looking for a fixed rate. You know, I'm only going to have to deploy this money in 3 months, 6 months, 9 months, 15 months. I want to get as much interest on this money while I have it as humanly possible. CDs are the most attractive option. They're still FDIC insured like a high yield savings account will be, but there are contractual guarantees between yourself and that financial institution. So that basically means that you are guaranteeing that money to stay there, and they're going to guarantee you that interest rate as long as you fulfill your end of the bargain through that duration that's been agreed upon. If you breach it, they at that point in time can claw back the interest that they were going to pay you or did pay you. And depending on how early you breached that CD agreement, you could end up losing some of your principal. So to help you get an understanding with the CD portion of it, because a lot of people don't understand, with CDs, the earlier in that contract you breach it, to say if it's a 3-month CD and you go in and breach it a week later into agreeing to that CD, that's the highest penalty you're going to have. It's front loaded, if you will. So it basically means that you completed the shortest duration of that contractual agreement. So you take the stiffest penalty. If you go all the way through the 3 months, and let's just say you get to 2 months and 29 days, you're going to pay the lowest penalty. You might not have much of any penalty. It could be pennies on a dollar, because you fulfilled the bulk of that agreement before you breach the contract. So anything in between, you can do the math on that in your mind. But again, the penalty is front loaded. The more of that contractual guarantee you fulfill, the smaller the penalty is going to be on the back end. So when you look at IRAs, again, this is obviously going to be a longer term play. But if you're starting to consider the idea of saving for retirement and you have excess cash flow, or you have a lump sum of money you can start with, IRAs can be a great independent option for you to start chipping away towards your retirement bucket. IRAs are going to allot you the ability to put $7,000, or at the time of this recording, $7,500 in contributions a year in. You're going to have IRA traditional option on IRA or the Roth option on an IRA. One is going to give you pre-tax benefits, and there's pre-tax dollars going in, and you get benefits and deductions that you can take on a yearly basis as you contribute to that IRA, which is your traditional. You can do the Roth option, which is going to be after-tax dollars or post-tax dollars, money you may have left over that's already been taxed on. You put that into your Roth IRA, and that's going to give you benefits that will allow you to take the money out typically tax-free once you hit that retirement age. So that's really going to be up to you to decide, am I better benefited by getting my tax deductions along the way, $7,500 a year at the time of this recording, or would I prefer to put my money in, pay my taxes, put the money in, and get all of my money and my earnings out tax-free later on down the line? There's a whole nother conversation that has been had on this channel about, Roth and traditional. I also can film another one if you guys are curious a little bit more depth about that or clarity on that. But that's generally the basic framework and the options that you have with an IRA. So to give some additional clarity to kind of wrap this up, essentially your high yield savings accounts, HYSAs, are going to be for short term or uncertain durations of time that you still want to get a decent return on your money. CDs are for when you are absolutely certain that the money is going to be able to sit for at minimum a certain window of time. And you still want a contractual guarantee. Another benefit of the CD is in an interest rate environment like we are at the time of this recording, where rates can, potentially stay still or maybe even go up some or come down at any given point in time based on what's going on in the economic system as a whole. CDs are guaranteeing you that rate no matter what's going on in the marketplace. It's a contractual guarantee. So if interest rates have the probability of changing 3, 4, or 5 times during the term of your CD, maybe you did a 1-year CD and then Federal Reserve's meeting 4 or 5 times or whatever number of times they may be meeting in a given year, typically 8, then even if they change interest rate every time at every meeting, your CD is secure. Your high yield savings account is not. your IRA does not actually really earn interest. I mean, technically you do an IRA deposit style or like an IRA CD you could, but I'm really focusing on IRA retirement accounts where it's typically going to go into some kind of equity investment like stocks or bonds. And that scenario is not really about you getting a fixed interest rate paid by the banks. That's going to be kind of a mid hub of the IRAs, of a tax shelter that's going to go around your stock investing or your bond investing. And you're going to be getting market returns at that point in time. And you're typically not going to be dealing with an FDIC insured situation with that type of setup either. So that's something to keep in mind. Hopefully this gave you a little bit of clarity. I think this is something that's like one of those basic topics, but a lot of people don't realize that they don't really know which one has made, makes the most sense or how to decipher which route to go. So I thought it would be a good video topic to cover because a lot of you may be in a situation where you have that excess cash. You've never really had clarity on when it's time to be in a high yield savings account. When is it time to transition to a CD? When is it time to get into an IRA? It's kind of a financial order of operations type of concept. So hopefully this made sense for you. Comment down below and let me know what your thoughts, questions, feedback, experiences may be around any of these different accounts. What you're doing with your excess cash flow or your lump sum of money, if you have it. How are you putting that money to work? And what has been your experience if you've used any of these 3 products? Have you had positive experiences? Did you have any lessons learned from using these products? Comment down below and let's keep the conversation going. Other than that, I want you guys to like, comment, share, subscribe. You know how to support the channel so the channel can continue to reinvest and support you. I want each of you to drop in the description down below. Check it out on Instagram. I branched the channel out as well as some additional postings on Instagram. We're branching out one social media at a time to expand our committee, expand on our experiences, our education, and continue to grow a stronger network. So check me out on Instagram. Other than that, I want each and every one of you to stay focused, stay in motion. I'll see y'all soon.